We were just kind of showing the inverted yield curve. We're going to put it up one more time. We've been talking about this for months, as we just mentioned, 220 trading days, so all the way since July of last year. So in your mind, is it still a recession indicator, or has it been going on so long that maybe it's not giving us the same signals it once did?
No, I still think it's recessionary. It's just showing you that the growth prospects aren't there, and that's reflected in the rates for the 10-year being less than the 2-year. It's sort of a strange conundrum because on one hand we have all this bad economic data, not just the yield curve, but you've had earnings growth decidedly negative. GDP growth was 12% 2 years ago. Now it's less than 1%, and yet the market still keeps marching higher. And I think now it's time to really focus in on your process and stick to your guiding principles. I suspect that if you got 17 at the blackjack table and you drew a 4, that didn't mean you made a good decision. You just got lucky. And I think if you look at GDP growth and inflation decelerating, you want to own things that will protect you in that environment. And if you've owned gold and things of that nature, you've actually protected yourself on the downside when the market was going lower last year, without giving away much in terms of capital appreciation on the upside.
All right, let's talk a little bit more about that downside, especially when it comes to downside protection for portfolios. You're looking at commodities for downside protection, at least in the near term. So I want to ask you, why commodities instead of tech? Tech's booming.
Right. So actually, commodities have actually been negative because there's no growth. And you saw that last week. I mean, last month, oil and corn and soybeans are down sometimes almost by 10%. So commodities won't protect you in this environment. Tech has done well. I'll remind people that, if you look at the NASDAQ earnings growth is down almost 10%. It's still 16% below where you could have bought it at the cycle highs. And it's also the growth has been very concentrated.
Wait, but Ivory, I want to jump in for a second. But you're really bullish on gold, which is a commodity.
Yeah, gold, but gold is more a store of value. It's a safe haven. So that's why I've been bullish on gold. If you're really aggressive, you can buy gold miners. And then for conservative investors, money markets are paying you 4.5%. With little volatility. So I'd make the distinction between gold and, the oil and natural gas and soybean and corn.
But gold is a way to protect the portfolio, you believe, in the near term at least?
I certainly believe so. It certainly protected us over the last year or so. Again, it's seen as a safe haven, a store of value, if you will. And so anytime you see growth and inflation decelerate, historically, you get a better chance of outperforming the market.
All right. But if we get a deal, do you get out of gold? And if you do, what do you get into when you get out of gold?
Yeah, I think you get out of gold when you see the GDP and inflation accelerate. So you're going from bad to good, which would be great. I don't think the debt ceiling is going to impact gold because our economy will still be in the same place. The debt, if the debt ceiling doesn't, if we default on our debt, that's a whole nother.
That is a whole nother thing. That is a whole other thing.
But fixing it isn't going to change things.
Yeah.